You keep getting into trades right when the move is almost over. The MACD gives you a bullish crossover. You enter with confidence, and then the market stalls. Sometimes it reverses immediately. Sometimes it drifts sideways until your conviction disappears. The frustrating part is that the signal wasn't wrong. It was simply late, and that raises an uncomfortable question. Have you been using MACD to confirm a move that already happened? There's a secret hidden inside MACD that rarely gets discussed. The crossover is not the main story. The distance between the lines is. Think about it. What does MACD actually measure? It measures momentum, not price itself, but the rate at which price is moving. And momentum often changes before trend changes become obvious. Have you ever noticed how the strongest moves sometimes begin when the MACD lines are still far apart and pointing in the same direction? Meanwhile, traders who wait for the next crossover are standing on the platform after the train has already left. That's because the crossover is a consequence. Momentum expansion is the cause. When the gap between the MACD line and the signal line starts widening, it tells you that buyers or sellers are becoming more aggressive. The market is not merely moving, it is accelerating, and acceleration is what creates the large moves traders dream about. Now ask yourself this: where do the biggest losses come from? Often they come from entering when momentum is already fading. The crossover finally appears. Everyone sees it. The chart looks clean. But underneath the surface, the force that created the move is weakening. The market may still be rising, yet momentum is no longer expanding. Cause and effect matter. When momentum slows, trend eventually struggles. Not always immediately, but the seed has been planted. This changes how you read MACD. Instead of staring at crossovers, watch the behavior of the histogram. Is it growing? Is it shrinking? Is each momentum wave stronger than the previous one or weaker? These questions reveal far more than a simple signal line crossing another. Have you ever seen price make a new high while the histogram makes a lower high? That is not merely a pattern. It is information. It tells you that price is advancing with less force than before. Buyers are still pushing, but not with the same commitment. The crowd sees strength. Momentum sees exhaustion. And this is where psychology enters the picture. Markets rarely turn because everyone suddenly changes their mind at once. They turn because the enthusiasm that fueled the move gradually disappears. MACD, when used correctly, helps you observe that process in real time. So the practical application is simple. Before taking a trade, stop asking, did I get a crossover? Instead ask, is momentum expanding or contracting? Look for widening momentum during the early stages of a move. Be cautious when momentum shrinks while price continues pushing in the same direction. Pay special attention when price makes a fresh extreme, but MACD fails to confirm it. Because the traders who consistently survive are not chasing signals. They are studying the pressure underneath those signals. A surprising number of traders use MACD as if it were a forecasting tool. They look at a crossover, a histogram shift, or a turn in the indicator and immediately ask, where is price going next? That question sounds reasonable, but it points attention in the wrong direction. MACD was never designed to predict where the market will go. It was designed to show how strongly the market is moving right now. That may seem like a small distinction, but it changes everything. Think about what happens during a powerful trend. Price begins moving higher, momentum increases, and MACD responds. The indicator is not creating a forecast, it is measuring participation. It is showing that buyers are becoming more aggressive than they were before. Do you see the difference? One approach asks the indicator to tell the future. The other uses it to measure what is happening beneath the surface of the present. The market rewards the second approach far more often. A trader who treats MACD as a prediction tool is constantly searching for certainty. Every signal becomes a promise. Every crossover becomes an expectation. The problem is that markets do not owe anyone a continuation. Momentum can appear and disappear. Participation can increase and then fade. But when MACD is viewed as a timing tool, the question changes. Instead of asking, will this move continue? You begin asking, are market participants becoming more active in this direction right now? That question is grounded in evidence. Price trends exist because people commit capital. As participation increases, momentum expands. As momentum expands, MACD responds. The indicator is not predicting the behavior. It is measuring the behavior. This is why some of the best trades occur when traders stop trying to forecast exact outcomes. Have you ever noticed that the strongest moves often feel obvious only after they have already begun? That is because markets rarely announce themselves in advance. They reveal themselves through action. Participation comes first. Recognition comes later. HD helps bridge that gap. When momentum begins strengthening, the indicator provides evidence that something is changing. Not certainty, not a prophecy, evidence. And evidence is enough. A professional trader does not need to know where the market will be next week. He only needs to recognize when conditions are becoming favorable for participation. If momentum continues, he benefits. If momentum fades, the evidence changes and he responds accordingly. That mindset creates an entirely different relationship with the indicator. You stop treating MACD signals as commands. You start treating them as observations. A crossover is not telling you what must happen. It is showing that the balance of participation has shifted. A rising histogram is not predicting a future rally. It is showing that momentum is currently strengthening. Cause and effect matter. Participation creates momentum. Momentum influences price movement. MACD measures that momentum. The indicator sits in the middle of the chain, not at the end of it. Once you understand this, chart reading becomes more practical. When you see momentum expanding, you recognize that participation is increasing. When momentum stalls, you recognize that participation is no longer accelerating. You are no longer asking the indicator to perform a task it was never built to perform. You are using it for what it does best, helping you identify when the market is becoming active enough to justify involvement. One of the reasons MACD gets misunderstood is that traders see the signals without understanding the mathematics underneath them. They see lines crossing. They see bars growing and shrinking. They learn the patterns. But very few stop and ask a simple question: what is MACD actually measuring? The answer is surprisingly important because every indicator has limits built into its mathematics. If you do not understand what an indicator is calculating, you will eventually expect information that it cannot provide. At its core, MACD is measuring the relationship between two moving averages. MACD MEMA, fast, slow. That is all it is. The indicator takes a faster average and compares it to a slower average. When the faster average moves away from the slower one, MACD rises. When it moves closer, MACD falls. Notice what is missing. There is no volume calculation. There is no order flow calculation. There is no support or resistance calculation. MACD does not know why price is moving. It only knows that recent prices are moving differently than older prices. That distinction matters. Because the indicator is built from moving averages, it is mathematically tied to historical prices. It can only process information that has already appeared on the chart. Every value comes from prices that already exist. Can you see the implication? MACD cannot detect information that price has not yet revealed. It cannot anticipate a news release. It cannot anticipate a large institution entering the market. It cannot anticipate a sudden shift in sentiment. Those events may eventually influence MACD, but only after they influence price first. The mathematics create a natural limitation. Price changes first. The moving averages adjust second. MACD responds third. This sequence can never be reversed because of how the calculation is constructed. That is why traders often complain that MACD is late. In reality, the indicator is behaving exactly as the mathematics require. An average must wait for data before it can average that data. A comparison between averages must wait even longer. The delay is not a flaw. It is the cost of smoothing market noise, and that reveals an important trade-off. The smoother the information, the slower the response. The faster the response, the less smoothing you receive. The mathematics force that compromise. No indicator can escape it completely. This also explains why MACD performs differently in different environments. When price trends steadily, the difference between the fast and slow averages becomes meaningful. The mathematics produce a clean picture because the market is producing a consistent pattern. When price moves randomly, those same calculations become less useful. The averages repeatedly converge and diverge because the underlying price movement lacks direction. The indicator has not changed. The mathematics have not changed. Only the quality of the price movement has changed. Now consider what MACD can never measure. It cannot tell you whether a move is fundamentally justified. It cannot tell you whether a market is expensive or cheap. It cannot tell you whether buyers are institutions, hedge funds, or retail traders. Why? Because none of those variables exist inside the calculation. The indicator can only measure the changing relationship between recent prices and less recent prices. Nothing more, nothing less. Once you understand this, you stop looking at MACD as a source of hidden market knowledge. Instead, you begin viewing it as a mathematical lens. A lens can clarify certain things while remaining completely blind to others. And the traders who use MACD effectively are usually the ones who respect both sides of that reality. They understand exactly what information the formula is capable of producing, and just as importantly, they understand what information the formula can never provide. One of the most important things MACD reveals has very little to do with direction. It reveals the life cycle of momentum. Every market move begins the same way. Participation increases. Activity expands. Price starts moving faster than it was before. At first, the change is subtle. Most traders do not notice it because they are focused on where price is, not on how its behavior is changing. But behavior changes before appearance changes. That is the first secret. A trend does not become strong the moment everyone recognizes it. By the time recognition arrives, the process has already been underway. Momentum begins expanding first. Price responds. Public recognition comes later. This is why MACD can reveal something valuable about market behavior. When momentum expands, the distance between short-term and longer-term price movement increases. The market is no longer moving at its previous pace. Buyers or sellers are becoming more aggressive. The rate of movement is accelerating. Think about a train leaving a station. The important moment is not when the train reaches full speed. The important moment is when it begins accelerating. That acceleration tells you something has changed. Markets behave similarly. The strongest trends are usually not created by a single burst of activity. They are created by sustained acceleration. More participants enter. Existing participants become more committed. The imbalance grows. Momentum expands. And as long as that expansion continues, the trend has fuel. Now consider the opposite process. Most traders expect a trend to end with a dramatic reversal. Sometimes that happens. More often, the trend begins dying long before the actual reversal appears. Why? Because momentum follows a natural cycle. First it expands, then it reaches a peak, then expansion slows. Finally, contraction begins. Price may continue moving higher during this process. In fact, that is often what makes it difficult to recognize. The chart still looks strong. New highs may still appear. Yet underneath the surface, the rate of acceleration is weakening. Cause and effect matter. When momentum stops expanding, the force driving the trend is no longer increasing. The move may continue for a time, but the engine is producing less additional power than before. This is where many traders become confused. They watch price and see continuation. MACD watches momentum and sees deterioration. Both observations can be true at the same time. Have you ever seen a market make a fresh high that somehow felt less impressive than the previous one? That feeling often comes from this exact process. The market is still advancing, but it is doing so with less force. The trend remains visible, yet the expansion phase is no longer intact. That distinction is important because markets rarely move from strength to weakness in a single step. There is usually a transition period. Momentum contracts before behavior changes enough for everyone to notice. The crowd sees price. Momentum reveals the condition beneath price. Once you understand this cycle, MACD becomes less of a signal generator and more of a window into market behavior. You begin observing whether momentum is expanding, stabilizing, or contracting. You stop treating every move as identical. A market with increasing momentum is behaving differently from a market with decreasing momentum, even if both are moving in the same direction. And when you start studying charts through that lens, an interesting pattern emerges. The most important information is often not found in the moments when momentum is clearly strong or clearly weak. The quality of a trader's results is often determined by the quality of a trader's questions. That may sound simple, but it explains why two people can look at the exact same MACD chart and reach completely different conclusions. One trader asks, "Is this a buy signal?" The other asks, "Is momentum expanding or contracting?" The chart is identical. The indicator is identical. Yet the second question reveals far more useful information. Why? Because good decisions begin with useful observations. A buy signal is an interpretation. Momentum expansion is an observable condition. The difference matters. When traders focus on signals, they immediately jump to conclusions. They move from observation to action without fully understanding what the indicator is actually showing. The chart becomes a collection of commands. But markets rarely reward that kind of thinking. The better question is not asking what you should do. The better question is asking what is happening. MACD becomes far more valuable when used this way. Instead of searching for permission to enter a trade, you begin investigating the condition of momentum itself. Is momentum becoming stronger? Is it becoming weaker? Is it accelerating? Is it losing speed? These questions force you to study the behavior underneath the signal. Have you noticed how often traders become trapped by certainty? They see a crossover and immediately decide the market should move higher. The signal becomes the answer, but effective decision-making works in the opposite direction. The signal should create a question, not end the investigation. A crossover occurs. Now what does that crossover actually represent? Is momentum genuinely increasing, or is the movement relatively small? Is the indicator showing meaningful separation, or merely a temporary fluctuation? Is the condition improving or deteriorating? Each question adds context. Each answer improves judgment, and judgment is what ultimately produces decisions. This is where the single most important MACD question emerges. What is momentum doing right now? Not what might happen tomorrow. Not where price might be next week. What is momentum doing now? That question keeps your attention anchored to reality. Markets change continuously. Because they change continuously, the quality of a decision depends on how accurately you read current conditions. The trader focused on predictions is often disconnected from present evidence. The trader focused on current momentum remains connected to what the market is actually revealing. Cause and effect become clearer as a result. When momentum expands, the market is demonstrating increasing strength of movement. When momentum contracts, that strength is diminishing. The decision itself comes later. First comes observation, then understanding, then action. Most traders reverse that sequence. They want action immediately. As a result, they often use MACD as a shortcut around thinking. They search for signals because signals appear to eliminate uncertainty. But uncertainty never disappears. The market is uncertain by nature. The real advantage comes from asking questions that help you navigate that uncertainty more intelligently. That is why the phrase, "Is momentum expanding or contracting?" is so powerful. It is specific. It is measurable. It is directly connected to what MACD was designed to show. And unlike many trading questions, it does not force you into a prediction. It simply forces you to read the evidence. Once you begin viewing MACD through that lens, the indicator becomes less about generating answers and more about improving the quality of your decisions. You become less concerned with what the signal suggests and more concerned with what the underlying condition reveals. And that shift in questioning gradually changes something else as well. One of the biggest differences between amateur traders and experienced traders is not the indicator they use. It is the role they assign to the indicator. The amateur uses MACD as a prediction machine. The professional uses MACD as part of a process. At first glance, those approaches may appear similar. Both traders look at the same chart. Both see the same lines and histogram. Yet the outcome is often completely different because the indicator serves a different purpose in their routine. A prediction tool tries to answer a future question. A process tool helps organize present information. That distinction changes everything. When MACD becomes a prediction tool, every signal carries too much weight. The trader waits for the indicator to deliver an answer. The chart becomes a place to search for certainty. But markets do not provide certainty, they provide information. The trader who understands this stops asking MACD to make decisions on his behalf. Instead, he uses it to structure observation. Think about how a skilled craftsman uses measuring tools. The ruler does not build the furniture. The ruler helps maintain consistency throughout the process. MACD works in a similar way. Its value comes from helping you evaluate momentum in a consistent manner. It creates a framework for observation. It gives you a repeatable way to assess a specific aspect of market behavior. That is a process. Have you ever noticed how traders often become dependent on indicators? They stop analyzing and start waiting. They wait for a crossover. They wait for confirmation. They wait for permission. The indicator gradually takes control of the decision-making process. The problem is that indicators were never designed for that responsibility. MACD measures momentum, nothing more. Once you understand that, the indicator becomes a tool inside your process rather than the process itself, and that creates an important shift. You stop asking, "What does MACD want me to do?" You begin asking, "What information is MACD contributing to my analysis?" The first question creates dependency. The second question creates discipline. Cause and effect matter here as well. When traders rely on indicators to make decisions, they often become inconsistent. Every new signal feels important because it appears to contain an answer. When traders use indicators as process tools, consistency improves. The indicator performs the same job every day. It measures the same thing. It provides the same type of information. That consistency allows the trader to build routines around observation rather than reaction. The professional mindset is surprisingly simple. Before looking at MACD, know what role MACD is supposed to play. Not what role you hope it will play. Not what role social media claims it plays. Its actual role. The indicator exists to provide information about momentum conditions. That information becomes one step within a larger process of evaluating a market. Nothing more. Nothing less. This approach also prevents a common problem. Indicators tend to attract unrealistic expectations. Traders want them to identify every opportunity, avoid every loss, and predict every major move. Eventually, disappointment follows because no indicator can perform all those functions. A process tool has a narrower responsibility. Its job is not to solve the entire puzzle. Its job is to help you evaluate one piece of the puzzle consistently. That is why experienced traders often appear less impressed by indicators than beginners. They are not searching for magical signals. They are building repeatable processes. One of the most expensive mistakes in trading is assuming that trade management begins when price reverses. By the time a reversal becomes obvious, a large part of the information has already been revealed. The market has been leaving clues for some time. The challenge is recognizing those clues while the trade still appears healthy. This is where MACD becomes surprisingly useful, not because it tells you exactly when to exit, not because it predicts reversals, but because it can help you detect momentum deterioration before trouble becomes visible in price alone. Think about a strong trend. In its healthiest stage, momentum continues expanding. Each push carries energy. The movement maintains force. The trend progresses with relatively little resistance. Now consider what happens when that strength begins fading. Price may continue moving in the same direction. New highs or new lows may still appear. To the casual observer, nothing seems wrong. Yet underneath the surface, the quality of the movement has changed. The market is still advancing, but it is doing so with less momentum than before. That distinction is important because trends are sustained by force. When force weakens, the trend does not necessarily end immediately, but the conditions supporting the trend are no longer improving. Cause and effect matter. Momentum deterioration does not guarantee a reversal. What it does indicate is that the engine driving the move is becoming less powerful than it was previously. The difference may seem subtle, but effective trade management often depends on subtle changes. Have you ever watched a profitable trade continue higher while somehow feeling less convincing with each new advance? That sensation often comes from observing price without consciously recognizing the changing momentum beneath it. MACD helps make that process visible. When momentum peaks and begins contracting, the indicator reflects the change. The market may still be moving favorably, but the rate of progress is no longer as strong. This information becomes valuable because trade management is not only about protecting against losses, it is also about evaluating the condition of an open position. A position entered under strong momentum conditions is not the same position when momentum begins deteriorating. The market environment has changed, and whenever conditions change, management decisions deserve renewed attention. Notice what this means. You are no longer managing a trade based solely on where price is. You are managing a trade based on the condition of the move itself. That creates a deeper level of awareness. Price tells you what the market has accomplished. Momentum tells you how much force is still supporting that accomplishment. The two pieces of information work together. A market can continue advancing while momentum contracts. A market can stall while momentum stabilizes. A market can produce fresh highs while underlying strength quietly fades. These situations look similar on the surface, yet they represent very different conditions for an open trade. That is why experienced traders often pay close attention to changes in momentum quality. Not because they expect immediate reversals, not because they are trying to predict exact turning points, but because deterioration is information, and information should influence management. The practical application is straightforward. While a trade remains active, continue evaluating whether momentum is maintaining, improving, or weakening. Treat momentum as a condition that evolves rather than a signal that appears once and then becomes irrelevant. The trade does not stop changing simply because you entered it. The market continues providing new information with every phase of the move. And sometimes the most valuable information arrives not when momentum is strong, but when it quietly begins losing strength, because that transition often reveals something important about the changing character of the opportunity itself. The market does not charge traders for lacking information as often as it charges them for misinterpreting information. That distinction becomes very clear when studying MACD. Most of the costly mistakes associated with the indicator do not come from the indicator itself. They come from assumptions traders attach to it. They see a signal, assign meaning that was never there, and then act on a conclusion the indicator never actually supported. One of the most common mistakes is treating every crossover as equally important. At first glance, this seems reasonable. A crossover is visible, easy to identify, and simple to follow. The problem is that crossovers occur under very different market conditions. Some happen during strong momentum expansion, others occur during weak, indecisive price movement. The signal may look identical, but the underlying conditions are completely different. When traders ignore those differences, they begin treating every crossover as if it carries the same information. It does not. Another mistake is confusing movement with strength. A market can be moving in a particular direction without displaying increasing momentum. Yet many traders assume that if price is advancing, MACD must automatically be confirming strength. That assumption creates problems because movement and momentum are related but not identical. A move can continue while strength gradually diminishes. When traders fail to recognize this distinction, they often misread what the indicator is actually communicating. Have you ever noticed how some traders become obsessed with whether MACD is above or below zero? The zero line certainly contains information, but another common mistake is treating it as a magical dividing line. The indicator crossing above zero does not transform a market into a perfect opportunity. Crossing below zero does not automatically invalidate a market. The zero line is a reference point, not a verdict. When traders assign absolute meaning to it, they stop observing the broader context of momentum behavior. Then there is perhaps the most subtle mistake of all. Many traders focus exclusively on the signal itself and completely ignore the rate of change behind the signal. Imagine watching a car's position while ignoring its speed. You would know where the car is, but you would miss critical information about how it is moving. A similar problem occurs with MACD. The trader sees the crossover, but ignores whether momentum is accelerating, slowing, stabilizing, or fading. Attention becomes fixed on the event rather than the condition, and conditions matter more than events. The deeper issue connecting all four mistakes is surprisingly simple. Traders often reduce MACD to a collection of shortcuts. A crossover becomes a shortcut. The zero line becomes a shortcut. A histogram change becomes a shortcut. The desire for quick interpretation replaces the effort required for accurate interpretation. Cause and effect follow naturally. The simpler the shortcut, the more information gets discarded. The more information gets discarded, the less reliable the conclusion becomes.